You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Good morning, Scientologists. This is my fifth appearance at Stocktoberfest in 6 years. And I remember when it was called Linsenpalooza, and I remember the nail salon. It's been an amazing series of events. And I think this year is probably going to be the best one yet. I'll let you know later. But I was offered 15 minutes to basically do whatever I felt like doing. What I'm going to do is a very stripped down, fast version of my typical presentation, which is where I talk about trends within the wealth management space. I think it's what I know best. I think it's what I could do the best job here to give you some things to think about. So I want to talk about why there has never been a better time to be in the business of progressive, forward-thinking advice and help to investors. I truly feel that we're in that moment, and we have been for a little while. Just very quickly, if you're not familiar with me, I write a blog called The Reformed Broker. It is true that StockTwits put me on their platform when no one else cared who I was or what I had to say, and really, really did a lot for me in the early days, and I'll never forget it. Howard calls in that favor 3 or 4 times a year, every year, but I'm endlessly grateful. I've been known to tweet once in a while, and use StockTwits as well. The Wall Street Journal, Time Magazine, Barron's, very early on, I didn't have much competition, so I was lucky, and they named me the top follow in the industry. So that's pretty cool. And I think a lot of those followers are real people. I'm not sure how many. These are the books. Backstage Wall Street, Business Insider called it riveting. The New York Times referred to it as adequate. Clash of the Financial Pundits, which Jeff Mackey, who's here, wrote with me a couple years ago. And then, of course, there's my daytime soap. This is called The Halftime Report. Most of you in this room watch this on mute, so if you didn't know what my voice sounded like, you're welcome. Now you know. The way this works is whoever's the loudest is right, and I'm always right. This is my day job, and and Michael Batnick, who you see here, is here as well, and he's going to do something incredible after this that I'm really looking forward to. But everyone that works at the firm found us through social media. They were reading our blogs. They were following us on StockTwits or on Twitter or on any of the various platforms where we say what we want to say, and they agree. We don't recruit. We don't go looking for people. If they agree with the way we think investors ought to be treated and money ought to be managed, that's the best possible starting point for employment with us. And we now are 14 people, and we've quadrupled in assets under management in just 3 years. We're doing this with social media, and I got to tell you something. I think no matter what you do, but finance is the subject today, if you cannot communicate your ideas in 2016, you may as well not exist professionally. This is just the way it is. You don't have to like it, but you have to get used to it. And it's fun to watch some of the largest brands in finance completely stumble and not understand this concept. And Howard can quote you chapter and verse. Writing about investing on a daily basis, I think, has made me a better investor. I think it really helps me communicate with our clients and our other advisors, frankly, about what we're doing, why we're doing it, why it's going to work. The best investors of all time were great writers. Go down the list. Warren Buffett, Howard Marks, Peter Lynch, Ray Dalio, Jeremy Grantham, David Einhorn, George Soros, all great writers. Everyone in this room has read something by each of them at some point. They've written books, newsletters, Dear Investor letters, etc. They know how to communicate what they're doing. And I'll tell you why this is so important. If you can't get someone to believe in what you're doing and agree with it and understand it, they're not going to stick with it when they really need to, right? When times get tough, when the market goes against goes against us, the economy, when there's fear everywhere. Your investor needs to understand what it is that you're doing, or they're out. They're out. It's very simple. And I think we had that realization early on, that communication was going to be part of our investment process. And I think was very rare. I think people are coming around to that idea. A lot of people in this room. And it's working. We're the 6th fastest growing firm in the country. I have some clients of mine in the room. What's up, Joe? We've got advisors all over the country, and it's really, really gratifying to be able to see that. My personal belief, again, there's never been a better time to be an advisor. There are massive shifts happening, which Howard discussed, in demographics, regulation, the economy, and it puts advisors in a position to have a major positive impact in people's lives. Consumer households now have $38 trillion in investable assets, $60 trillion in financial assets. 30 trillion of that is going to be transferred over the next 10 to 15 years. That's the estimate that everyone's running with. If it's even half true, that's an extraordinary number. 66% of children, adult children, who inherit their parents' money end up leaving the incumbent advisor. And that number is trending up. 66%, 2/3. Where do they go? They're looking for advisors who have a presence online, who stand for something, who have a message. They don't care about full-page ads in magazines. They don't care to play golf and meet a financial advisor. What they really want to know is how you invest, why you do it a certain way, why it's good for them, and they want to be able to digest that message on their own time, on a phone, on a social network, on a blog, on LinkedIn, whatever it is. That is going to be the differentiator in the next go-round. Not golf courses, not charities that you pretend to care about. That world is coming to an end. The new world is the web. I don't think that's a controversial statement anymore. Millennials would rather do anything than sit inside your oak-paneled conference room. They just don't want to do it. They want to communicate with you at their pace when they feel like it. They want it on demand. They want it on demand. I think that's a really important concept as well. There are a lot of people in this room working on that problem of communicating with investors, communicating with traders, and I think it's an important problem. Very quickly, this is what the industry looks like now. 301,000 FAs in America. There were 340,000 in 2005. We're shrinking. We're shrinking at a time when our services are more necessary than ever. We also have a graying industry. The average age of a financial advisor is 50.9 years old. 43% of the industry is over 55. 1/3 of advisors are between 50 and 64, and guess what? They're planning their own retirement over the next few years. We have one of the oldest industries in America, second only to Walmart store greeters. This bodes very well for those of us who have the energy, the vitalogy, and the will to be building a business right now while the sun is setting on so many former wealth management practices and brands. So yes, there are trillions of dollars in assets that are up for grabs. I tell people that we would not be a suitable advisor for most of those assets. I'm very, very upfront about that. I only want to work with people who I can actually help. I did it the other way around for 10 years in the retail brokerage space, where you would take money from anyone who would give it to you. I could tell you that's a horrendous way to live. So I think fit is really, really key, and I think it's the only way to grow a firm. It sounds counterintuitive to say no to people. When you say no for the right reasons, a lot of doors open up for you that you had not previously believed existed. Howard Marks at Oaktree said something very important about not just being a great investor, but running a great investment management business. He said, tell the client what you are going to do and then do it. Sounds so easy, right? Sounds so obvious. That is not the way most of the industry operates. That's going to change. I'm happy to be at the forefront of that changing. As an advisor, you can't help everyone. You've got to start with the people who are receptive to what you're promising to do for them and realistic in terms of their expectations. You've got to be dealing with people that agree that at a baseline, capitalism works, markets work, risk-taking is rewarded, and that the world is probably not coming to an end next Tuesday. You've got to at least have that starting point that what we're doing has the chance to work. So don't go to Vancouver Gold conferences looking to meet investors. I learned that. All right. Let me get into this really quickly because I think it's important. I don't know if anyone else is going to bring it up today. We've had a watershed event in investment management this year with the Department of Labor's ruling. All retirement accounts, including IRAs, 401ks, must be managed according to a fiduciary standard as opposed to a mere suitability standard. I don't think the industry understands how profound this shift is. It seems like they've all exhaled and they think it's over. I think it's just getting started. One of the most extreme views I've heard about this is from Larry Fink. Spoke to a group of us in New York. He's the CEO of BlackRock, the largest asset manager in the world. Larry Fink says, right now you have a few 100,000 financial advisors running around the country acting as their own CIO, acting as their own PM for all of their clients. That is going to be a very difficult proposition going forward because of regulation and the threat of litigation. Merrill Lynch probably doesn't want to have 30,000 advisors calling their own shots on every account for very much longer. What that leads to, though, is not necessarily a great thing. What that leads to is a centralized CIO, which is what we have at our firm. We create investment strategies centrally and allow advisors to use them, but we're not a $4 trillion firm like BlackRock, so there's no systemic risk there. However, when a majority of the industry is shifting in that direction, all of a sudden you have no one on the other side of the trade. If everyone is in the same 10 ETFs, that presents a new systemic risk that's probably a bigger risk to most investors than a conflicted broker who's at least doing something different. So I don't view this issue as black and white, good guys versus bad guys. I think there's a lot of gray area in between, and I hope that the threat of litigation doesn't push 150 million American savers into identical portfolios, because I don't think that's good for the financial system, and I think it introduces new risks that we probably haven't thought about. Just get into this very quickly. How am I doing on time? All right. With the time I have left, I just want to get into our investment beliefs, our role as money managers, how we think about that. What we're trying to do is marry very well thought out asset allocation with the latest in behavioral finance. And again, this means a huge emphasis on communication. Behavior is going to dictate the vast majority of the differences in people's results over time, much more so than asset allocation, believe it or not. So we want to be at the forefront of that. Absent the presence of a comprehensive financial plan and an investment policy statement, we don't talk to anyone about a portfolio. We absolutely have to know why we're investing, how we're investing, and how it relates to the real-life goals that the client has. To talk about beating an index is irrelevant when you're looking at somebody across the table who's got to figure out funding their entire life for the next 30 years, and then beyond them, if they're lucky to live that long, what happens to their spouse, what happens to their next generation. That's the conversation that adds value. Coke or Pepsi into quarterly earnings, who gives a shit, right? So I think the industry is coming around to that idea, and I think that it's really, really important if you're running money for people. You don't have to be a CFP, but what you're doing on the asset management side has to answer some very basic questions about what are we looking to accomplish, when do we need to accomplish it by, how do taxes factor in, inflation, et cetera. So we're having those conversations. We also believe in something called evidence-based investing. This is not to say we bow down to academic studies or data without thinking for ourselves. I think the trick is utilizing the data in a way that squares with real-life experience and live markets. This is something that academics rarely have a chance to do. James Simons at Renaissance is one anomaly, but he's in the woods somewhere in eastern Long Island. He doesn't talk to anyone. So strategic asset allocation, Michael Batnick likes to say, it means always having to say you're sorry and never having to say you're sorry. This is a strategy that's predicated on humility. We do not know what's going to happen. We don't know what's going to outperform and underperform. We know, however, that there is mean reversion, and we can take advantage of that with a plan in advance, not making things up on the fly, not trading based on newspaper headlines or statements from ECB ministers or anything like that. And then we try to bring in tactical, which I think is really, really necessary because, again, if we're talking about behavior, we've got to have an emotional release valve. The answer cannot be just do nothing, everything will be fine. That works on paper, doesn't work in real life. I think most people in this room would agree with that. I think everyone right now is a passive investor in their own mind. They like to say they are. It's popular, it's the zeitgeist. I don't know if after the next bear market occurs, which I'm told started 4 years ago, we just don't know it yet. But after the next bear market, I don't know how many of the newly passive investors are still passive. If they haven't built themselves a mechanism that removes volatility, reduces risk, gives them a behavioral breath of fresh air when they need it most, right? I think locking yourself into something is really, really going to be difficult when times get tough. So we try to marry the idea of strategic asset allocation with tactical. I think we do so in a very evidence-based way. By the way, this squares completely with the best academic literature. In 2013, the Nobel Prize for Economics went to 3 professors who had spent a lifetime, 50 years, studying markets. Gene Fama at the University of Chicago is the father of efficient markets. Robert Shiller at Yale is the man who coined the term irrational exuberance. He believes in the opposite of efficient markets. He believes that emotion is what drives asset class returns and risk. The guy in the middle, I don't know who that is. Maybe he invented the lightning round from Mad Money or something. Whatever, it's not important. The point is marrying strategic asset allocation with tactical management, I think, brings the best insights of Fama and Shiller together all in one portfolio. Their ideas are in opposition academically, but in the real world, they accomplish the most important thing, producing long-term returns for investors while limiting the risk of their blowing it all because of either fear at a top or greed at a bottom. And then, just to wrap up, when we built Tactical, this is all the stuff we threw out. And Ian Rosen will agree, this looks like the homepage of MarketWatch on any given day. I know this stuff is interesting. I talk about this stuff on TV all the time. I'm not a hypocrite. I agree that it's important to be aware of. The thing is, when you test it, not one of these things will give you a reliable buy or sell or hold signal. Sometimes they matter, sometimes they don't. Nobody rings a bell and tells you, okay, this is the week you want to pay attention to insider selling. Or the magazine cover indicator. It didn't matter the last 8 magazines, this one it does. Honestly, this is like lifting a 100-pound weight off my shoulders to throw all of this out. So how are we doing tactical? We're using price and we're using trend. And I think this whole conference is about trends. JC Peretz, who's here, you'll hear from him later. Somebody once asked him, what's your favorite technical analysis indicator, if you could only have one? He said price. It sounds like a smart-ass answer, but really, when you test everything else, price is the primary. And everything else sometimes is helpful, sometimes isn't. Trend is trend. So the challenge for us became, how do you implement this in such a way that you don't get whipsawed by every counter-trend move in the market, that you're not trading every rip and every dip? We're a wealth management firm, so we have taxes to consider and other factors. So that was kind of the idea. But because we're not a prop shop, because we're not a hedge fund, we had to be a little bit more sensitive to things that more active traders didn't need to be. But I think marrying these two things is really important. This is my last slide. I think these are things worth considering. I don't know how long this will stay up here. These are the things that if anyone wants to email me or talk to me about these ideas, I think that this is what we should all be considering in various aspects of our business. I don't think we're doing Q&A, but anyway, I really appreciate. All right, we'll do that later. I really appreciate the time, guys. If I was talking fast because I wanted to get to everything, Howard, thank you for having me once again, and I really enjoyed meeting everyone last night and more today. And let's have some fun. Thank you.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.